Ladies and gentlemen, good day and welcome to Blue Star Limited's Q3 and 9 months FY22 earnings conference call. We have with us today from the management, Mr. Neeraj Basu, Group Chief Financial Officer of Blue Star Limited. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Neeraj Basu. Thank you, and over to you, sir.
Thank you. Good morning, ladies and gentlemen. This is Neeraj Basu. I will be providing you an overview of the results of Blue Star Limited for the quarter ended December 2021. But before I get started, I would like to wish all of you a Happy New Year, and I hope you and your families are safe and this third wave of COVID did not impact anyone significantly. So on that note, I'll start with the financial highlights first. Across businesses, our focus on expanding distribution reach and efforts to consolidate our market share worked out well. Our product portfolio and service solutions continue to generate encouraging traction across all customer segments. During the quarter,
Requesting all the participants to please stay connected while we reconnect the management. Ladies and gentlemen, the line for the management is reconnected. Thank you, and over to you, Mr. Basu.
thank you very much, and my apologies for this. The line got disconnected. I will start again. I was going to talk about our financial highlights. Across businesses, our focus on expanding distribution reach and efforts to consolidate our market share worked out well. Our product portfolio and service solutions continue to generate encouraging traction across all customer segments. During the quarter, the pandemic impact remained relatively benign and non-disruptive. The revival of business and economic activities enabled us to end the quarter on a strong note, with all the business segments witnessing robust volume growth. The consolidated revenue from operations and revenue from each of the segments for the quarter surpassed revenue achieved by us in the pre-pandemic period. However, increase in commodity prices, cost of raw materials, and ocean freight continue to exert pressures on gross margins. Financial highlights for the quarter ended December 31, 2021 on a consolidated basis are being summarized by me now as follows. Revenue from operations for Q3 FY22 grew 34% to rupees 1506.22 crore as compared to rupees 1123.89 crore in Q3 FY21. EBITDA, excluding other income and finance income, for Q3 FY22 was rupees 90.59 crore, EBITDA margin 6% of revenue, as compared to rupees 81.56 crore, EBITDA margin 7.3% of revenue for Q3 FY21. Impact of increase in commodity prices, raw materials and ocean freight, and rollback of cuts in discretionary spend that we had undertaken in FY21 led to lower EBITDA for Q3 FY22. Profit before tax grew 41.4% to rupees 70.32 crore in Q3 FY22 as compared to rupees 49.73 crore in Q3 FY21. Tax expense for Q3 FY22 was rupees 22.75 crore as compared to rupees 12.96 crore in Q3 FY21. Net profit for Q3 FY22 grew by 29.4% to rupees 47.57 crore as compared to rupees 36.77 crore in Q3 FY21. Carried forward order book as of December 31, 2021 grew by 4.5% to rupees 3301.33 crore as compared to rupees 3157.90 crore as on December 31, 2020. Capital employed increased to rupees 1105.98 crore as on December 31, 2021 as compared to rupees 948.62 crore as on December 31, 2020. Planned advancement in the inventory levels was done to mitigate the increase in the procurement timelines of long lead raw materials and components in order to meet the upcoming season. Net borrowing as on December 31, 2021 increased marginally to rupees 165.11 crore. That was a debt equity ratio of 0.18 as compared to net borrowing of rupees 131.01 crore as of December 31, 2020 with a debt equity ratio of 0.16 owing to the increase in inventory and investment in the expansion projects at Sri City and our Wada plant. I'll cover the business highlights for Q3 FY22 now. First, segment 1, electromechanical projects and commercial air conditioning systems. Segment 1 revenue grew 41.7% to rupees 829.85 crore in Q3 FY22 as compared to rupees 585.49 crore in Q3 FY21. Segment result was rupees 52.41 crore, which was 6.3% of revenue in Q3 FY22 as against a profit of rupees 34.11 crore, which was 5.8% of revenue in Q3 FY21. Order inflow for the quarter grew by 34% to rupees 852.82 crore as compared to rupees 636.54 crore in Q3 FY21. Our electromechanical projects business, driven by capex commitments by the private sector, order inflows from the factory and light industrial sector continued to be encouraging. Inflow of orders from the infrastructure sector, including MEP projects and water distribution, picked up during the quarter. Inquiries and orders from the commercial building sector were also encouraging. Carried forward order book of the electromechanical project business was rupees 2311 crore as on December 31, 2021 as compared to rupees 2217 crore as on December 31, 2020, a growth of 4.2%. Commercial air conditioning systems. Healthcare, pharma, industrial and government customer segments continue to offer encouraging opportunities, while traditional customer segments such as builder, retail, IT and educational institutions witnessed increased pace of revival, enabling a growth for the commercial air conditioning business during the quarter. We continue to maintain our number one position in ducted air conditioning, second position in VRF, and moved up to second position in screw chillers during the quarter. Major orders bagged in Q3 FY22 were from Avenue Supermarkets, DSR Builders, Olympia Cyberspace, and JSW Steel. Our international business, stability in the business environment, and a general pickup in the economic activities in the Middle East markets enabled growth in revenue during the quarter. With the growth of QSRs in the region, demand for our refrigeration solutions improved during the period. We also witnessed good traction for our products in the newly entered market of Tanzania. The project business in Qatar continued to do well. The operations at the joint venture at Malaysia continued to be impacted due to the restrictions on account of COVID. We continue to explore new markets for business opportunities and focus on the expansion of Blue Star product range and building brand awareness and brand visibility in different markets that we are present in overseas. I will now talk about Segment 2, Unitary Products. Our Segment 2 revenue grew 23.7% to rupees 609.68 crore in Q3 FY22 as compared to rupees 492.97 crore in Q3 FY21. Segment results was rupees 38.78 crore, which was 6.4% of revenue in Q3 FY22 as compared to rupees 38.79 crore, which was 7.9% of revenue in Q3 FY21. Continuous rise in input costs, disruptions in the international supply chain, increased supply lead time coupled with pressures on realizations owing to competitive pressures led to a drop in segment margins for the quarter. Cooling and purification products business, despite lower than anticipated sales during the festival season, focus on expansion of distribution footprint enabled a 28% growth in revenue from our room air conditioner business during the quarter. We grew faster than the market and ended the quarter with a market share of 13.25% with robust growth in the month of December. We further consolidated our position in e-commerce and modern trade with significant contribution from these channels to the overall revenue. The construction of a new factory at Sri City is progressing as planned and is expected to be commissioned by October 22. Our application for PLI benefits for sheet metal components and heat exchangers has been approved as earlier envisaged. Commercial refrigeration business, improvement in demand for modular cold rooms from the pharma, healthcare, e-commerce and food and beverages segment coupled with the revival in the demand for kitchen refrigeration equipment with the opening up of hotels and restaurants enabled growth in revenue for the commercial refrigeration business during the quarter. Additionally, availability of a wide selection of models in varying capacities enabled increased traction for Visi coolers during the period. We continue to maintain our leadership position in deep freezers, storage water coolers and modular cold rooms in this category. I will now talk about Segment 3, Professional Electronics and Industrial Systems. Segment 3 revenue grew by 46.8% to rupees 66.69 crore in Q3 FY22 as compared to rupees 45.43 crore in Q3 FY21. Segment result was rupees 12.76 crore, which was 19.1% of revenue in Q3 FY22 as compared with rupees 8.26 crore, which was 18.2% of revenue in Q3 FY21. Revenue for the quarter grew on the back of a few major orders executed in the data security solutions business and growth in revenue from the healthcare business. The testing machine business also continued to witness growth with a revival of investments in the manufacturing sector. Major orders were backed from JSW Steel, ICICI Bank, FIS Payment Solutions, and Reliance Industries, to name a few. With the wide portfolio of products and solutions forming part of our offering, the prospects for this business segment continue to be positive. Business outlook. The disruption in the month of January 22 due to the third wave of the pandemic was moderate, and we expect the economic activities to once again gain momentum from the last week of February. We anticipate that the peak selling months commencing March will not be impacted. Our mass premium product portfolio in the room air conditioner business continues to resonate well with the distributors and customers. Prospects for the expanded range of commercial refrigeration products are encouraging. We continue to remain optimistic on the growth prospects in the projects business across the select customer segments focused by us. Increased capex investments by both the public and private sectors are expected to offer good prospects for the electromechanical projects business. While the margins are likely to continue to remain impacted in the short term, we expect revenue growth to be robust. Prudent working capital management will continue to result in healthy cash flows and a strong balance sheet. With that, ladies and gentlemen, I'm done with the opening remarks. I would like to now pass it back to the moderator, who will open the floors to questions. I will try and answer as many questions as I can. To the extent I'm unable, To do that, we'll get back to you via email. With that, we are open for questions.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. We would request all the participants to please limit their questions to two per participant. For any follow-up, may be requested to rejoin the queue. Thank you. The first question is from the line of Nitin Arora from Axis Mutual Fund. Please go ahead.
Hi, Neeraj. Morning.
Hi,
Thanks for taking my question. Just on the dwelling more on the room AC side, you said that Blue Star grew by 28%. Is it possible to help us how much the market grew by? Because your opening remark said that the demand was not that great as per the anticipation. We were listening to Veer as well on TV. He said there's a 25% growth in the quarter for the industry, whereas other companies are reporting a decline by the same amount in volumes. So if you can help us understand what really happened in the quarter with respect to the market and yours. And second, if the demand is so strong and you are increasing market share, why not Blue Star go on ahead and took a price hike and get the margins up? So if you can throw some light on that, that's my first question. Then I'll take up the second one.
Sure. Thanks, Nitin. Yes. So our understanding of the market growth in this quarter, our understanding has been a little bit of a mixed bag. But overall, we believe, or our own checks suggest that it's around 25%. You may find different results for different players, but by and large, the market has done reasonably okay across few players. And in that context, what we said, our growth has been 28%, which has enabled us to consolidate the market share somewhat more. So while the festival demand wasn't that great as expected, but the month of December and part of month of November demand has been quite encouraging. That's where I guess the quarter has, on an overall basis, performed well. That's what our experience has been. To your question on could we have taken further price hikes? Now, so you need to bear in mind that probably we were amongst the few players who already took 3 price hikes in 2021. And you remember from our last earnings call, the last price increase we took was in the month of September. Now, whether all the players took equal quantum and value of price increases looks a bit unlikely. So we needed to calibrate our overall market operating prices as well in order for us not to become an outlier. And then obviously you are aware there are competitive pressures all the time. So we didn't consider it appropriate to consider any further price increases because we had already taken price increases. The margin impact that you see, like I mentioned, is on 2 counts. Of course, there is continued commodity price pressures which have not abated even in Q3. Which pretty much you will probably find from other account as well, other account of other players as well. So commodity price pressures continue, input cost pressures continue, which is what is kind of eating into the price increase impact considered. The full impact of these price increases once Q4 plays out fully. And with this pandemic not impacting, this third wave not impacting as severely as the earlier 2 waves, we are quite hopeful that the competitive pressures in Q4, if they start easing out by February or early March, then hopefully a part of that should also get translated into the better margin profile starting Q4. So at this stage, we are not considering any further price increase in Q4 either.
Got it. My second question is with respect to the product which you placed.
I'm sorry, your voice is breaking. If you can.
Yeah. Are you able to hear me now? I'm audible?
Yes, you're audible now.
Yeah. So the second question was that the products which you launched in the mass segment, and there was almost 2 times the COVID came. And we were trying to test the product and the market, but I think it both impacted both the waves. Now, when at this time you have launched, Is it more of primary growth which has come in the number? Can you throw some light how the secondary sales have responded to this particular category which you have launched across the market? That would be helpful. That's my
question. So when we talk about growth numbers, we always talk about the growth in value terms and growth in the primary market. That's the consistent reporting that we do. Having said that, our understanding and our experience with the new product portfolio, the mass premium product portfolio in the room AC segment, has been quite encouraging. This is indeed helping us to expand our outreach as far as the target customer segment as well as distribution is concerned equally well. The entire portfolio is resonating well with the end customers. And of course, the dealers and distributors are happy to sell this new range as well. Now, you're right that we've not had a full one financial year good run with the new portfolio ever since we launched this. So we are hoping that Q4 and then Q1 next year, we should get a good healthy traction and have a full impact of this portfolio as well.
Got it, Neeraj. I'll come back in the queue for more questions. Thank you so much for answering.
Thank you.
Thank you. Next question is from the line of Manoj Gori from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity, sir. First of all, congratulations for the good set of numbers in the current environment. Sir, my question is more on the industry outlook. So obviously, when you look at, there is a bit of sluggishness in the consumer demand. However, if you look at last 2 years, industry has lost significant portion of volumes in terms of secondary optics during peak summer period. So how do you look at the overall demand environment?
Yeah.
So that's my first question. Yeah.
Sure. So Manoj, the overall demand outlook or demand environment in our category, and I'm probably talking about room AC here, is actually encouraging because unlike other consumer durable categories, probably room ACs or air conditioning requirements at home with the hybrid working environment, if not completely work from home, continuing across now a number of Indian cities. So you need to bear in mind when this pandemic started, probably these lockdowns were more acutely felt in larger towns and cities. But then over the last 2 years, pretty much most tier 1 and 2 towns and cities across the country are now following this approach. So that's indeed something which creates demand for all home or household conveniences, of which room air conditioners for sure is one important category that every household wants to focus upon. If for an extended period of time schools have been working in an offline mode, on an online mode, and working class people have been working from home. Now, what has dampened in the last 2 years the full potential of the demand to get converted into actual sales is the disruption in the ability to distribute, because whenever we've had situations where, let's say, modern trade got impacted or the markets were not permitted to sell, and it's happened twice now in the first quarter. Of course, the disruption quantum was lower in FY21 as compared to FY20, but that is what makes people a little unsure about stepping out to go out and buy. That is the reason you also see e-commerce taking off quite nicely in this category over the last 2 years as far as the market is concerned. So our premises is that the demand continues to remain quite robust. It is the environment and the disruptiveness which has been there in the environment which probably impacted the full potential to be realized. Now, the only factor that remains is the summer intensity. Now, with the expectation that this year summer should start setting in as normal somewhere towards beginning of March, we see no reason why Q4 and then again Q1 of FY23 should not play out as a normal summer selling season plays out in this category. Of course, we are assuming that there won't be a fourth wave which hits us in April. Hopefully looks unlikely because we've just been through one wave in January. And even if there's no new variant which emerges in the next 5-6 months, at least that gives us good runway in our category to sell as normal. So that's what we are considering, and that's what gives us this element of optimism in terms of the Q4 prospects as well.
Yeah, thanks. So basically, if you look at, obviously, we are sitting on a favorable base at the industry level, and also there is a lot of pent-up demand, plus the outlook continues. So during next year, what is the growth that you estimate for the industry, and how Blue Star should pan out, given that South markets were relatively weaker as compared to other geographies over the last 2 years? So how do you see yourself placed for the upcoming summer, and how do you see the industry growing next year? That's my last question, sir.
Correct. So see, if you just go back to pre-pandemic normal growth period which we were experiencing, the growth CAGR used to be in the range of 15 to 18%, and in a good year even going up to 20%. So we see no reason why in case we are out of these disruptions, market should not get back to 15 to 18% CAGR in FY23. Our stated position remains consistent because we are already sitting on some 13.2% market share. We would like this to scale up to 15%, and how much of that we achieve in FY23 will certainly be an area of focus for us. So our endeavor will be to grow faster than the market in FY23. So that's how we think the market should come back on the normal growth trajectory starting next year.
Yeah. So thanks a lot, sir. We'll get back in the queue and wish you all the best.
Thank you very much, Manoj.
Thank you. The next question is from the line of Ravi Swaminathan from Spark Capital. Please go ahead.
Hi, sir. Thanks a lot for taking my question. My first question is in terms of visibility of growth in the project business. So what kind of growth that we can see in the project business? From where can the large orders come from, like metros, rail, data centers, etc.? You can review a view, that will be great, sir.
Right. So Ravi, yes, the project business, you're aware that we've adopted a slightly different approach for the last 2 years, where we focused on select customer segments that we keep talking about, where the credit profile, the customers' overall, credibility and credit profile is rather assured, and where the growth prospects are encouraging. So in other words, we've been focusing a lot more on industrial factories, e-commerce, warehouses, data centers, and so on, in addition to the infra sector, which we continue to focus on. Now, with the encouraging, if you see the enabling factors, where whether you say because of PLI-driven commitments that private sector seems to be doing on the factory side, a lot of commitments have already been announced last year, which will now get into fructification. And then in the budget this year again, there is a good amount of capex commitment by the government on the infra sector. So we believe it should augur well for this segment, and we see no reason why a growth of maybe 12 to 15% should not be possible, at least in FY23. And then as some of these projects gain more traction, then the growth rates should get sustained for at least the next couple of years. So we indeed seem to be getting into a new capex cycle, which actually started in FY22. The early signals of that started this year itself, but with more normalization of economic and business environment, and with less and less disruptions because of pandemic, this should become more visible to all of us. So we again are quite optimistic on the growth prospects of segment 1.
Got it, sir. And my second question is with respect to margins. There are 2 parts in this. One is your commentary on the steady state margins in both the EMP and the cooling product segment. In cooling products, keeping in mind the mix, that is mass premium, input cost increase, operating leverage, all, if you can comment on that. And also on the unallocable expense. So basically, it has now hovering at 20 crores per quarter. and last year it was on the lower side. So what is the steady state unallocable expense that we need to look at over the next 1 to 2 years? So if you can comment on this.
Yeah, Ravi, let me talk about unallocable expenses first, because after a very long period of time, somebody has touched that question. So well, last year, you remember we had taken the unallocable expenses for us actually largely our corporate management team's salaries and the related expenses. Mostly we are not keeping anything unallocated. Last year we had taken fairly incisive salary cuts, ranging from 35 to 50%, so which have now been rolled back. Our steady state quarterly unallocable is in the range of 20-25% if you see even pre-pandemic, which translates to around 1.5 to 1.7% of the overall revenues, which when we benchmark ourselves with our peers, we are in a healthy ballpark range as far as that is concerned. So that's not an area of concern at all. Now coming to your question on the segment margin. I'll restrict my commentary today to quarter 4 because we are yet to work out our entire pricing and overall operating plan for FY23. So we'll cover that probably in May when we meet again. So quarter 4, like I said, with healthy traction in the overall sales in both the segments continuing, as well as there is some little easing of commodity prices, which we are just experiencing, maybe early days for that. It will not translate into any great benefit in Q4. But with if the competitive pressures on pricing sort of taper off in Q4, because that's the real determinant of effective realization that we can expect. If that starts to happen, and once the demand momentum is experienced by most players, then of course the realizations will start looking better, and that should get us to a margin profile of about 7% or so in segment 2 in quarter 4. Segment 1 has been pretty stable, which you would have experienced or seen. It is going to hover in the range of 5.5 to 6%, because again the determinants there are the size of the jobs that get concluded and closed, and so it will range in the same ballpark range of 5.5 to 6 even in quarter 4. And segment 3 again 18 to 20% has been a consistent kind of a view, and there are quarters where it has been a little lower, but around 18 to 20% in quarter 4. So that's what our expectation for quarter 4 remains, and yes, that is a good starting point for us to enter FY23.
Got it, sir. Thanks a lot, sir. Thanks.
Thank you. The next question is from the line of Sandeep Tulsian from JM Financial. Please go ahead.
Yeah, very good morning. Here's my first question is pertaining to the summer season demand, just harping on that point again. If you look at the normalized number that Blue Star did 2 summers back, was close to 1,600 crores, went down to as low as 800 crores in the following summer and came back to 1,200 crores last year. Now, if we were to peg this year's summer demand versus that 1,600 crore number, in terms of what will be the pricing increase you would have taken over that period, and what is the kind of volume growth that you can see for this summer season, keeping that in mind, and how this number would be split between RAC as well as your commercial rest business, if you can give some color on that. That's the first question.
Yes, so Sandeep, like I said, our FY23 plans are still in the making. We haven't, and we very consciously delayed our planning exercise a little bit because we wanted to be clear on how this third wave will play out. There was no point in making a plan in February, March, and then so that exercise will now happen slightly later, and that's where probably we can give you some more color on how the entire summer season, which starts in March and then rolls over to Q1 next year, will play out in terms of demand, pricing, etc. So we are not ready with an answer yet on that part. I can talk about quarter 4, and like I said, quarter 4, whatever price increases Blue Star had to introduce and absorb have already been done over 3 rounds in FY22. It actually started in Q4 last year, or first quarter of the calendar of 2021. So we have done that. We need to actually now wait for a little bit of calibration of the price absorption across the top few players, and once that starts to happen, then you will see a much better realization profile in order to absorb some of these input cost pressures across the board. That, along with if we are optimistic about a good selling opportunity starting February end, March beginning, should definitely get translated into better margin realization in quarter 4 for us, which I said should be around 7% in segment 2. So that's what we are looking at, and of course we need to we will get back to you on FY23, and also keep in mind there is a table change that's going to happen from July 22, which will be, though it is not happening in the first quarter, that also we'll have to factor in, because that does change completely the entire complexion of the blended pricing, and that kind of resets a lot of variables in the market as well. So that's what I guess we'll be able to give you some more clarity sometime later.
But what would be the cumulative price increase over last 2 years to compare?
No, so I'll talk about current financial year. So we are basically last calendar year 21, which is 1 quarter of FY20 and then this one. Over this period, we have taken around 15% price increase in 3 installments. That's already been considered and taken.
Got it. And second, little bit if you can elaborate on your comment regarding the expansion of distribution reach. So in the previous call, you had highlighted that North as a region has become bigger, of course, because due to muted demand due to monsoons in South also, but they were contributing equally and totally were about 70% of your sales. So if you can give some more color and more, expand your comment on this distribution reach expansion, what do you exactly imply by this, and how has been the regional contribution moved in the current quarter?
Yeah, so that continues to play well, Sandeep. Firstly, the number of stores that we are now serving is now touching 7,500 plus in quarter 3. This has gone up close to, you can say some 15-20% over comparable period last year. And the productivity, the activity levels in these stores is looking quite healthy. This number we expect to touch to 8,000 by the time we exit this current financial year. So there's a lot of work happening on that part. That's what when I said expansion of distribution, I meant that. Within this, of course, like we mentioned last quarter, North continues to track well and is now measuring up quite nicely as far as the overall share of business is concerned. So overall, we are having a situation where North and South are almost at an equitable level in terms of our overall contribution to sales, followed a notch level below by West. So North has indeed caught up for us in the last, I would say, couple of years now.
Got it. Thank you. I'll come back with more questions. Thank you.
Sure.
Thank you. The next question is from the line of Anupam Gupta from IIFL Capital. Please go ahead.
Yeah, hi Neeraj. So first question is on the margin trajectory for the product business, where you said that pricing action by competitors will be a big determinant. So as per you, what is the current, let's say, inventory levels which other companies are carrying, or what is driving that sort of higher price competition, and how do you see it moving over the fourth quarter?
Sorry, Anupam, is your question on the inventory level? I didn't hear that clearly.
So what I was asking is what sort of inventory levels do you see in the channel, both for you as well as for competitors, and which is driving the higher competitive pressure which you see, and how do you see it changing over the fourth quarter?
Got it. Yeah. So the good news is that again our impression or our checks suggest that by the end of December, inventory levels across the top few players are pretty normalized, and also with the channels is pretty normal in the context of a normal Q4. So that's the good news. Our inventory levels, you'll recall, started to normalize in Q2 itself, and we were pretty comfortable with our closing inventory levels end of September. The reason you will see slightly higher capital employed in segment 2, because we have consciously built up raw material and component inventory in order to counter or mitigate the impact of the lead times, which are still unstable as far as international supply chain is concerned. We didn't want to run the risk of any production disruption in Q4 or Q1. That's a conscious choice. So that's something which will get normalized by Q1 next year. We are not worried there. So overall, finished goods inventory, our checks suggest that it is beginning to look good, and end of December it was not out of range for it to cause a pricing pressure for at least few players. So yes, that remains to be seen now how the pricing plays out in Q4 with that background.
Okay. So just to continue there, would it be right to assume that given that everyone has this raw material pricing pressures and now the entry are normal as per you, the price hike should be pretty quick, or will a weak demand for that?
No, so the price hikes that get announced or that get rolled out, actually for them to get transmitted is where all these variables play out, because obviously there are all these pressures on account of inventory level and some players wanting to be more price aggressive start to make an impact. But in a quarter or quarters where the demand starts to grow rapidly because let's say summer season is pushing that demand, there's an element of pent-up demand, then most players will tend to normalize the pricing transmission quite rapidly. So the answer to your question is, even without necessarily taking any further price increases at least in the next 3 months, there's no reason why the effective realizations should not be some normalization in Q4 with a good traction on the demand side.
Okay. And just one question, if I may, on the project side. So you have, for the last 2 quarters, given a very healthy margin in the project business. And going by your commentary that both pace of execution as well as order finalizations are very healthy, should we not see these margins continue, and why is your guidance still lower than 6% there? If execution is strong and if order inflows are strong, ideally we should be able to give a slightly better margin trajectory there going ahead.
Yes, we wish that was the case, but the fact is that this is a very tightly costed category, and it's again in this category we need to follow a very balanced approach between what kind of business, what kind of orders we accept and what prices. How do we manage the contracting side of it, and how do we manage the exposures, which also include possible potential delays and also the customer's ability to honor their obligations apart from our obligations, and of course the cash flows. So when you triangulate these three, it's not going to be easy to have a situation where the margins keep increasing over a steady period of time. So the reason you see steadiness in our margin profile, so that's a trade-off. Either we can go aggressive on one of these 3 variables or 2 of these 3 variables, and then probably in the short run you may see a different profile. But if one needs to consider steadiness and consistency, then our experience tells us that this approach of a balance between these 3 variables will be healthy, will steady, healthy, and good healthy ROCs as well. So because when you see the ROC profile of the segment, it looks quite encouraging apart from the EBIT profile. So overall, we feel that this this consistent performance of 5.5 to 6% should continue. You will see quarters where it will be more than 6% also, but that will be sort of contingent upon certain large projects or projects with slightly healthier margins getting closed out, and so on. So to be you can say it's a bit conservative view, but we feel it's a more realistic view of where this segment can go. So with healthy growth rates and a steady margin of say 6% and an equally encouraging ROC profile, we are happy growing this entire category as we have been doing in the past.
Thank you. The next question is from the line of Bhavin Vitlani from SBI Mutual Fund. Please go ahead.
Thank you for the opportunity and congratulations for good numbers.
Thanks, Bhavin.
So Neeraj, if you could help us with an update on our expansion projects, what is the kind of timeline and the capacities that we're looking at?
Yeah. So Bhavin, there are 2 projects I'll talk about. Firstly, very shortly, I guess in the next 3 months, we will go live. We'll commission our second deep freezer manufacturing plant in Wada. Now this capex was underway for the last year and a half. In between, we had a little bit slowed down because of the pandemic, but now it's been brought back on track, and we expect this to go live very soon. This will help us. So the objective of setting this plant up in Wada was to substitute import of a few SKUs, which so far we've been importing. So this is kind of going to help us indigenize and for this segment reduce import dependence quite a bit. So that's what will help us. And of course, once we indigenize, it will have its own rub-off effect on the other downstream elements as well. The second project that's underway, under commissioning, under construction, is in Sri City, which should get commissioned by Q3 of this financial year in the quarter October to December. This will be, to begin with, we are going to set up the third room air conditioner manufacturing facility there in Sri City, along with in this plant is where we have applied and got the PLI benefit as well. Capacities are going to be phased out, so it's not that we are going to start. So this rollout will happen in phases, and we will keep augmenting the capacity of this plant to align and calibrate with the capacities we are having in our Himachal plants, the two Himachal plants, so that all the three plants put together again help us significantly increase the own manufactured base. So again, you'll remember that till 2 years ago there used to be certain imports which got reduced because of changes in the BCD structure over the last 2 years, and then of course we've been also buying from certain outsourced contract manufacturers. So the intent here is, while we'll continue with that arrangement for a select SKUs to buy locally, but the idea is to increase or it's a mixed change, fulfillment mixed change from combination of imports and ODM manufactured to our own manufactured. So traditionally we've maintained a 50 to 60% own manufactured proportion. After Sri City goes live, a combination of these three plants should take us to around 70% or even 75% over a period of next couple of years. So that's what is the plan, and we think we are well on our way to execute that plan as envisaged.
Sure. Just a follow-up on the freezers. What is the total capex incurred for, and what is the volumetric expansion on the capacity that will be from the current levels?
So the overall capex we've spent in this plant over the last 2 years is around 100 crores, which is more or less completed. So no further capex in this deep freezer plant is expected in FY23. Whatever needed to happen will conclude by FY22. In volumetric terms, I may not be able to give you an answer right away. But like I said, overall, the growth, this refrigeration, commercial refrigeration product is a subset of our segment 2, and this contributes equally well as far as the overall segment growth is concerned. So obviously, if our aspiration, let's say next year, is to take the growth to be higher than the market in whichever proportion, then that growth will percolate to commercial refrigeration as well. So that it is more at this point in time of import substitution, and then of course those capacities will help us scale up faster once this plant is fully operationalized by FY23.
Right, sure. And just a housekeeping question on the unitary product segment. If you could just help us with the mix with RAC and non-RAC for the current 9 months and the previous 9 months.
Yeah, so it's almost similar. Around 60% is RAC and 40% will be the basket of other non-RAC products. And it's remained pretty at that level because obviously RAC growth has been a bit, subdued over the last 2 years. It can go up to 65% for RAC when the growth rates assume. So you can take a 65-35% or 60-40 in that order.
Sure. And just last part,
Mr. Vitlan.
Sure.
So sorry to interrupt, but fine. Thank you. The next question is from the line of Neeraj Vasa from Anand Rathi. Please go ahead.
Hello, sir, and thank you very much for the opportunity. So, sir, just this is pertaining to the price hikes that we need. what I'm able to understand is that price hike is going to be a function of volume offtake. So just wanted to understand, if the season goes well, what is the kind of price hikes that can happen across Q4 and 1Q to pass on the cost?
Yeah. So Neeraj, I mentioned about this part a short while ago. So as far as Blue Star is concerned, we are not expecting to take any further price hike in Q4. So Q1, like I mentioned, we are not yet clear on the plan, which we have clarity by March, because we need to factor in not just the summer season offtake, but also the impact of the table changes which will happen from July onwards. So that question we will park for now. Q4, we are not anticipating any further price increases from our perspective, but we definitely expect probably other players to catch up on the price increases who were not able to take sufficient price increases in the last 3 quarters. At some stage, once the demand shows up for everyone, it will be a good opportunity for the entire market to become calibrated on the level of pricing, and that, like I mentioned, probably will have a favorable impact on the, at least the mitigation effect on the price, commodity prices, which are impacting everyone.
So the second question pertains to the ad spends that we will be looking for the peak summer season. Is the number for that finalized?
No, not yet. So it's a bit too early, and we need to like I said, we haven't made our plans yet for FY23, and we will be. But like you've seen us in the past, we usually calibrate that fairly quickly with the ongoing market conditions and market opportunity as well. But that clarity we'll get again in the month of March or April.
Thank you, sir.
Thank you.
Thank you. The next question is from the line of Sujit Jain from ASK Investment Managers. Please go ahead.
So I just wanted to check with you, since you said your price hike probably was not matched by some of the other players. Would that mean that your value growth is definitely higher, but volume growth could be similar to what industry would have done in Q3?
Possible, because see, it's not too much of a difference. Our own senses, the industry has grown by around 20-25%, and we are saying 28% for us. So that's maybe 500 basis points higher. And part of that, you're right, will be the impact of price increases also.
I checked your commentary for Q3 last year as well, where you talk about 13% market share and 13.2% market share Q3 FY22 as well. So
yes,
probably in terms of volume, and if you can also tell about 9-month volume for the industry and for you in terms of growth rates.
So Sujit, we always talk about the growth and market share in value terms, and re-clarifying that, because volumes are a bit inconsistent to track and explain. So we have always found value, and that's for primary markets. So I'm re-clarifying that part. So yes, our market share optically, if you see, is 13.25% over the last 1 year. We have been conscious not to go, just for the purpose of market share expansion, to have a further margin implication, because see, that's the trade-off. If one wants to be aggressive on the market share, then there is a margin trade-off impact as well. And since this entire pandemic has been playing on, so we have tried to be realistic as well as reasonably aggressive on holding on to the market levels, such that once the market normalizes, then of course that gives us much better clarity on the overall strategy that we can have on further augmenting this market share. So it's again partly by design and choice that we are just holding on to the market shares at these levels for now.
You can just share the 9-month value growth for you versus the industry, like you shared for Q3.
Yeah, I will just tell you. I will just tell you this number. In the meantime, we can move on to the next question. I will.
Sure. One last question. Capital employed, the entire increase is because of the higher inventory you've chosen, right? No capex has come into this gross block so far.
No, definitely. So it's a combination of both these things. So a short while ago, I was talking about capex that we have mostly finished in our Wada plant for deep freezers. That also sits under segment 2. So it's a combination of inventory for the room ACs and the capital expenditure that recently happened, recently as in last 1 year, for the deep freezer expansion. It's a combination of both.
VADA would have added 130 crores, right?
VADA would have added about 100 crores, but then there's normal routine capex also, no? In the plants where we are, we have the routine regular capex. So just to answer your question, Sujit, on the year-to-date 9 months market versus us, we have grown by around 36% for the first 9 months, and market growth rate, our check suggests is around 33 to 34%.
Sure, thank you.
Thank you. Take the next question, a follow-up from the line of Sandeep Tulsian from JM Financial. Please go ahead.
Yeah, hi Neeraj. I had a couple of follow-up questions. One was on the e-commerce share of sales, which you had mentioned that Blue Star was tracking a bit lower than the industry. About 13 to 14% of your sales came through e-commerce. So if you can just give an update and what is the outlook going forward on this side? What is the current share of sales from e-commerce?
Yeah, so for quarter 3, it is overall market was around 10%, and we were around 8% for quarter 3. For quarter 2, it was higher. The overall share was higher for market and as well as for us. On a year-to-date basis, the market is tracking at roughly around 18% of their overall share of e-commerce sales, and we'll be around 14 to 15% now.
Okay. On an annual basis, it will be 14 to 15%, right?
So you can assume, because I talked about 9 months, so we don't expect this to significantly change in quarter 4, the proportion.
Understood. And second question was regarding these tax breaks that is given under Section 115B, that is at 15% for new manufacturing units that can commence production till March 24 now. So for the new investment that we'll be doing under PLI, will that unit have this lower tax rate?
Correct, it will have. And of course, this extension of 1 year has happened only yesterday, day before yesterday. But we are on track to, like I said, go live with the commercial production in FY23 itself, much before March 23, which was the original drop dead date for that.
So how should we look at your tax rates going forward? Because, we're still tracking higher tax rate in the current quarter, significantly higher at 33%.
Yeah, so that's a normal tax rate because, till last year we had certain ATIC benefits in our Himachal plants, and which have since expired. That was a 10-year holiday that got expired. And then last year, obviously the profitability was lower till Q3, and you will see a full annualized tax rate of around 31% last year as well, because Q4 the profitability caught up. And we are at 32-33% right now. So that's pretty normal. That's a normal tax level that you can expect from an expected tax rate is concerned. We will be sharing again, like I said, once we are done with our budgets for next plan for the next year, a blended tax position for FY23 probably we'll share with you by May, but this should reduce because a combination of even from a Blue Star perspective, we will shift to the 25% tax regime from FY23. The full impact of this lower tax rate 115BA will not be available in FY23 for the new plant because it will be FY24 when they will be fully operational. So we'll give you some idea probably in May.
Thank you. As there are no further questions, I now hand the conference over to Mr. Neeraj Basu for closing comments. Over to you, sir.
Thank you very much, ladies and gentlemen. With this, we conclude this quarter's earnings call. Do feel free to revert to us in case any of your questions were not fully addressed, and we will be happy to provide you additional details by email or in person. So with that, wish you all the best and stay safe. Bye-bye.
Thank you. Ladies and gentlemen, on behalf of Blue Star Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.